What up, traders? Today, I'll be joined by Ngosilati, a financial market analyst who will take us through the impact of NFP and the impact it has on the dollar index as well as on the S&P 500.
Thanks for having me, Spook. It's been an interesting week, man. Last week, Friday, we saw NFP come out, which definitely surprised the market. It came in much lower than expected, and it was about half as much as what it was the month prior. So we're kind of starting to see some signs of the labor market cooling down, which is a good sign of what could be happening with inflation in the future. We all know the labor market, it drives inflation from the demand side. So if we're seeing some easing in the labor market conditions, then it could open the door to inflation coming down. So we saw the effects of this lower than expected NFP on the markets, and it was quite significant. So last week's lower than expected figure, it brought quite a big impact on the market. We saw the dollar index and as well as the S&P 500 move quite significantly. So in fact, let me start with the S&P 500 because that moved up 1%, which is significant in S&P 500 terms. And that brought it to back-to-back days of gains. So you could see that the market was now growing appetite for risk just based off of that NFP figure, because if there's a likelihood that inflation is going to come down, there's also a potential that the US interest rates will come down. So if the US interest rates do come down, then you're likely to see risk assets gain, as markets prefer risk assets over the US dollar or the bonds, which would likely start to yield less. So the markets responded quite significantly. You can see the S&P 500 was up nearly 1%, literally 0.99 basis points. But at the same time, the dollar index came down, and I just wanted to point out this dollar index because despite it coming down, it hit a low point for that day of 104.594, and it just shot back up to roughly about 105. So this, in candlestick terms, is a pin bar.
Yes,
it's got a long wick, and it's rejecting the downside. So there could be a likelihood that people want to actually buy the US dollar, after selling it so much. But we'll have to see in the coming week how the markets respond. But this could be a case where there might be a reversal, especially considering that there was some price interaction on the left side. If you look on the left of the chart,
prices
you see
reacting.
There was quite a swing point which was broken, and it's come back into that same zone where there was the initial swing point, and it seems to be reacting to that level. So let's see how it goes next week. If there is a reversal, I'd like to see some volumes going in favor of the buying side on the lower time frames. As you can see, this is the daily time frame. So we'll see next week how that goes.
Okay. Quick question. Are you happy with the volume when you're looking at that pin bar? How certain are you that the pin bar will yield an up move or the break of that previous structure that was formed? What's the chances of price going up from the pin bar based on the volume, or the price going down based on that pin bar, the relationship of the pin bar and the volume?
Well, if you look at the volume itself, it's had one of the highest volumes among most of the days that were traded, right? It's above basically the average. So it tells you that there was starting to come in some activity in the market, and it was buying activity because the price hit the low and pushed back up. So in terms of the chances of it actually reversing, we can never really know. But what we can do is wait for a certain catalyst during the week to see where it will support the dollar or not, right? But so far, given that the NFP has come down way below expectations and lower than the prior month, it could be a a chance where there might still be some selling of the dollar, since there was that weak labor market data.
Yeah.
So the dollar could still sell off, to be fair, on that data. But if something comes up as a catalyst to support the contrary, then a reversal could definitely apply here. But yeah, we'll just have to see.
Since you also have the S&P 500 open up, well, on your watch list, can we confirm the move on the dollar index based on what's happening on the S&P 500?
Certainly. So the dollar and the S&P 500, they operate on two different spectrums in terms of risk. So the dollar is a safe haven asset. So definitely it'll be your lower risk investments, over a longer term period, because it's backed by the US government, right?
Yeah.
Then the S&P 500 is more of a risk asset. Yeah. So we can see that there was a negative correlation, which played out pretty well on the day of the NFP. Because if you see the US 500 here, it shot up because the risk appetite was coming back into the market.
Yeah.
Based off of expectations that, inflationary pressures might not be as much, right? So it jumped up that 1%. And that's the opposite case for the US dollar, which then dropped down. And even though it recovered, it had dropped as much. It dropped 31 basis points on the day.
Yeah.
But if you look at the full price action, like for the amount it sold off, let me put my measurement tool here. If you look at that all day, it had dropped as much as 80 basis points.
That's a lot,
right? It's a lot. Almost aligning with the 1% that the S&P 500 had done.
So the correlation, the negative correlation is almost absolute, but negatively, like it's above 80%.
You could say so. You could say you can definitely say there is a negative correlation, because at the end of the day, capital is going to flow from one place to the other. Right. And if markets feel like risk assets hold too much risk at that moment, they're going to buy the dollar. But if they feel like they can take on risk, they're going to sell the dollar.
Yeah.
And this was exactly the case, that markets were taking on more risk, and they were selling off the dollar. And that's how it played out for the day. And let me see if I can maybe put this together.
In one chart. Okay.
Yeah.
So another more in detail question, considering that the S&P 500 is the sum of all the 500 companies in the US, and the dollar index being the consolidation of all the currencies that are paired against the dollar, is it possible to analyze both these instruments at a granular level? Like, for example, if we say, or we assume that the S&P 500 is mostly driven by 5 companies. Let's say I'll say it's the Microsoft, it's the Google, those big companies. Is it possible just to look at those companies as a sample to say that these companies are a representation of what might happen in the S&P 500, or do you need to consider the consolidated value of the S&P 500 in relation to the US dollar, where we can say that GBP USD and Euro USD are the predominant currencies that move the dollar index? Like, what's the right approach? Should you look at it from a holistic view, or should you use specific instruments within those instruments which determine the value of the dollar index as well as the S&P 500?
Yeah, that's a great question. I think that it really depends on how much work you want to put in. Let's look at the S&P 500. Right? Like you've mentioned, there are a couple big constituents which ultimately weigh more on the S&P 500, and essentially, when everyone is investing in these couple businesses, the index moves. So you're looking, like you said, your Google, you're looking at Meta, you're looking at Tesla, you're looking at what else is there? Nvidia, Amazon,
Netflix,
those kinds of things. Netflix, So if you see, you can look at those companies individually. If you want to put the work in, you can, because then they give you if you see some activity in those stocks, it'll give you an indication of what's likely happening on the S&P 500, because ultimately the S&P 500 houses those stocks, right? But at the same time, there is no harm in looking at the S&P 500 on its own in relation to the US dollar, because at the end of the day, and as much as those big constituents move the market, remember there's a bunch of other stocks in there. If you want to call the top 10 holding more than about 25% of the S&P 500, I mean, what about the rest of the 75%? What are they doing?
Yes,
they could weigh down on the index itself. So the S&P 500, it gives you that aggregated information which you can then use. If the market is moving up, then it tells you that the whole sector or the whole asset class is moving, so stocks are moving. You understand? And then you can start working out what kind of trades you want to take from that. But it really depends on the work you want to do. For me, I already enjoy looking at stocks, so I do spend a lot of time looking at stocks. I do spend a lot of time looking at what's on the underlying of the S&P 500 and the NASDAQ 100. Because that's pretty much where my interests are. But when I look at this as well, it tells me a broader perspective. It gives me a broader picture and a broader perspective to, for everything else that's under the S&P 500. As for the dollar index, it's also an aggregate. It's comparing the US dollar to the other major currencies. You understand? And what you'll find is that this, in most cases, the dollar index will have a positive correlation with your currency pairs. Right. So if the dollar index is moving down, it just tells me that it's moving down against all the major currencies.
Another question, which I've heard this term of correlation divergence, which to me means that two instruments that are known to have a positive correlation, at some point it happens that the correlation is not true, where, let's say, like you just determined that the correlation of S&P 500 as well as the dollar index is positive. So what happens when so we know that the correlation is negative, right? So what happens when they move the same, where they move the same as well, as in when the dollar index goes up, the S&P 500 goes up? In that particular scenario, what are the driving forces for that? And as a trader or investor, what sort of approach you need to use? Do you refrain from trading, or do you wait for the correlation to come back? If you trade, do you become aggressive, or do you what's the correct approach when such a scenario happens? Because to me, if we are trading based on correlation, that should be the governing factor of our trade. Like, that's our main base and our foundation to how we trade in our models. So in that scenario, what do we do in that scenario?
All right. So what you're saying there, we had something similar happen last year, right? Where we saw the dollar moving up, obviously supported by high interest rates in the US. And then obviously we saw the S&P 500 as well as the NASDAQ moving significantly higher last year. So if we put this on the 12, this could be something you show maybe potentially. So if you look at this chart, we're seeing something similar this year, where both the US dollar and the S&P 500 are moving up.
They're both bullish.
Ideally, that's a divergence of the correlation, because you'd expect them to be negatively correlated. So if the US dollar is moving up, you'd expect to see the S&P 500 move lower. Right. But what happens there is that there would be a catalyst that disturbs the correlation and eventually leads to the divergence. So for example, this year, you can look at it either way. If you're seeing the dollar up, then it's likely because there's safe haven demand, and that's most likely because of the wars that have been going on. That's kind of put pressure on the globe to look for safe haven assets. Right. But at the same time, you'd expect the S&P 500 to drop, but it hasn't. And that's because there's also a catalyst there that's pushing it up, which is the AI and tech stocks, which are moving significantly higher. They've been performing well since last year, right? So it depends which way you want to play here. If you are a risk-off individual, if you don't have too much appetite for risk, then you could wait it out because you want to then see how it plays out, right? Because what happens with the divergence is that at some point there's going to be convergence once again. So at some point things are going to normalize and you'll start seeing the negative correlation come back into play.
In terms of execution, right? There's different types of traders, of course. There's speculative traders, there's non-speculative traders, and there is hedge traders, all these kind of traders. So like, since everybody is using the same data, well, I assume that everyone is using the same data regarding macroeconomic data, geopolitical data, and all the data that is available that most traders use to make financial decisions or trading decisions, right? So my question is, what is the right time to make the decision to enter the entry after getting this data?
Okay. I mean, that really depends on the strategy that you use.
Yeah.
Right? It all comes down to the strategy, because at the end of the day, there's different types of traders, applying different types of approaches. Right?
Yeah.
But if we were to split it between a professional trader and a retail trader, right? What I can tell you is when the market is moving up, the professional trader is already in that market. You understand?
Yeah.
As for the retail trader, because we don't have all of the information at hand, we don't have order books, our volume might be different between broker and broker.
Yeah.
We don't have that level 1 data that we need in terms of finding our opportunities on the market, right? The best thing that we have at our advantage is the fundamentals and as well as the technical analysis. So for me, in this case, I'll speak on my behalf personally. Based on the fundamental picture, right? If you look at the NFP itself, you'll see that the labor market slowed down, right? Now, with that being said, and with that being the case, that the market is very inflation sensitive, what I want to now see is whether inflation can support the fact that the labor market cooled down. So if inflation does cool down, for me, I'm going to be looking to take longs on risk assets, you understand? Because that's what confirms the trade, you understand?
Yes.
Someone else might trade on NFP on the day and make money, as soon as the NFP comes out and make money off of the volatility itself. You understand? But for me, I'm not, in as much as I'd like taking risk, I like taking risk where it's supported by a lot more fundamental data than maybe one data point like the NFP. You understand? Because I'm more of a swing trader. So it really depends on the risk. Personally, I would want to see some more data supporting the idea that inflation is potentially going to come down and that interest rates are going to come down for me to really buy into the S&P 500, for example, over the long term. But if I don't get that, and we see inflation still being persistent, then I might be looking to take a short position on the S&P 500 or a long position on the dollar.
Makes sense.
I hope I answered your question, but for real, it depends on the strategy that you're using. For me, I'm a swing trader. I want to see the fundamental data align with the way the price is moving, also aligning with the way the volume is moving. So if volume and price are aligned, price is moving up and volumes are supporting the move up, as well as the fundamental data is supporting the trade, then I will take a trade. And for me, it doesn't matter, because it doesn't matter at what time I take it. It just has to be a case in which all of my factors and within my strategy align.
Makes sense. And what's your take on traders who make entries on the first minute of the fundamental data release? Like, because you find people because do they know something that we don't? Do they know exactly what the data will say? Like, what do you say about that?
Well, I'll say they've got big balls. I hope I can use that here.
Now you can. You can.
Yeah, because look, what they're betting on, right? Like I've said, there's so many different ways to trade. You could trade the trend, you could trade reversals, or you could trade the volatility. So what they do is they trade the volatility because they know once NFP hits and it's surprises, there's gonna be a lot of market movement.
Yeah.
You understand? So there's a lot of volatility. If you put a position on the high or low of the preceding candle, whatever time frame it may be, prior to the NFP, when the NFP or that big data point comes out, there's gonna be volatility. My issue is that with that volatility, it might hit, it might make the market move really high, or it might make the market move really low, right? Those two scenarios can happen. But with these big data points, right, it will make the market move high and low. So in such a significant move, very quickly, you understand? So that's why I say they've got big balls, because they're able to execute on that volatility. For me, that volatility is too much for me to execute on, or for many other people. That's why some people still sit out of, days when there's big economic events. You understand? Some people sit it out because the volatility might swing the market around in such a way that it's hard to actually tell which way it will go for the extended period.
Yeah. And so do you say the guys that do not sit down when there is big fundamental data release, can you say that those guys are gamblers? Is it safe to say that?
Not necessarily, because if they set their risk parameters right, then it's unlikely that they're gambling. Because at the end of the day, volatility is part of the game, right?
Yeah.
And if you trade the volatility on a given day, that could be your strategy. You understand?
Yeah.
But as long as you're managing the risk and taking a calculated move on these events, then I wouldn't say you're necessarily gambling, but you're just like any other trader placing a bet on which way the markets will move.
No, powerful, man. I think that should be the wrap up. I think you've covered most of the things that we need to know in terms of trading data like NFP for S&P 500 and US dollar, and also explaining the correlation between the two, and the other confirmations that we can use, such as volume, to ensure that we are in line with the market is doing. And we can add something else if you think there's something that we have missed on this session. But so far so good. I think for this session we've covered the most important parts, and anything that you think that we should take note of going forward when we look at the next NFP.
Yeah, I think you should try keep your risk to a minimum.
Yeah.
The markets are very risky, so if you're in the game, just try manage your risk. That's what keeps you in the game for long.
Yeah.
But at the same time, like we talked about, inflation is quite the hot topic right now, and monetary policy, the fundamental aspect of it, is what's going to drive the markets going forward.
Yes.
So for the next NFP, we have to pay attention to the inflation data before that, as well as the PCE data, which will come out just before that NFP figure, as well as that figure, to see if there's some solid trades that we can capitalize on, depending on the strategy that you use, of course. I like taking positions for days, so I'll be paying attention to those fundamental catalysts to see if there's any opportunities there, and I hope you can do the same too.
Definitely. We can also have sessions about them, especially inflation and interest rates, because those are the most important data, fundamental data that drives the market. So, now that we have covered the NFP data in relation to S&P and the dollar index, I think it's good to also cover inflation and interest rates.
Definitely. I look forward to catching up again. And thanks for having me.
Thank you very much for joining me today. Hope you have a successful trading week.
Definitely. Thanks, man. Have a good one.
Away, man. Bless up.